Good day, and thank you for joining us on our Hedge Fund educational series. My name is Richard Bray, and we are very proud to be part of this educational series, which will be one of 3 videos which we'll be sending to you over the next couple of months. The first part will be us having a very high-level look at hedge funds. What are they? How do they differentiate from long-only funds? What are the various strategies available, and how do you, as the financial advisor, access them on behalf of your clients? Our second video and third video will be a deeper dive into the hedge fund strategies available for fixed interest and for equities, respectively, in that space. So let's start with, what is the definition of a hedge fund? If you go and you look at these reputable sources, Investopedia, the Economic Times, Wikipedia, etc., you'll find that there is a variety of definitions that are extremely broad and, if anything, create more confusion than clarity as to what a hedge fund is. Therefore, the best way for me to describe to you what a hedge fund is to give you what the purpose of it is. Now, the purpose of a hedge fund is to provide asymmetrical returns. Symmetrical returns mean that should the market change or the price change by 15%, you'll get the same change in payoff that you normally would. In other words, you get the same proportion change, and the same happens on the upside. When you look at asymmetrical returns, you're trying to limit that downside participation, let's say to 5%. But in order to limit that downside participation, you will have to give up a little bit of the upside to pay for the cost of that protection. We call this asymmetrical returns, and what this does is provide a much more consistent return profile for investors, and therefore even reducing sequence risk. Because as Warren Buffett has famously said many, many times before, rule number 1 is never lose money, and rule number 2 is don't forget rule number 1. And the reason why he says this is that when you lose capital in a portfolio, you have to make up that capital before you start adding alpha or additional returns to your clients going forward. So I'm sure the next question you're probably asking, well, isn't my asset manager or my long-only manager already doing this in my unit trust? And you are correct, but there are a few differences that we need to just point out. One is your traditional asset manager or your long-only asset manager has a very traditional mindset, only playing in the well-known asset classes, be it cash, bonds, property, equities. Whereas a hedge fund manager has a lot more tools and instruments at their disposal. Traditionally with your investment managers or your traditional asset managers, they might use derivatives in a portfolio whereby they will hedge out a position. So an example in this regard would be an equity manager. He might have a 10% exposure to NASPAS, which is quite large in the portfolio, and he or she might decide to reduce the risk of that by adding a derivative and a downside protection on that individual security. Now, this can be done within a traditional long-only fund and can be done for specific securities to limit the downside. Compared to where you look at a hedge fund manager, where they can use a variety of additional instruments, be it leveraging, short selling, and protection as well. So I've mentioned protection and how long-only managers use it. Hedge fund managers use the same. However, what they are also able to do is they are able to short sell stocks. In other words, instead of providing a downside hedge or a downside protection, they can sell the stock without even having to own it in the beginning. In addition, they make use of things like leveraging, which can increase their market exposure, and then they can combine these to either provide additional return or generation or increases of alpha, and also reduce on the downside in terms of risk. The one thing that these hedge fund managers and traditional long-only managers do have in common, they are both have to work within a regulated investment vehicle, in other words, a collective investment scheme. So that should give you peace of mind that they are both highly regulated. It is no longer the case that hedge funds are not regulated. In addition, public and private institutions can invest in both hedge funds and long-only traditional funds. So I mentioned earlier on that you get various hedge funds, and there are various strategies that these hedge funds go to the market and strategies that they use to derive their returns. So on a very high level, you generally get about 4 strategies, or your 4 most common strategies is a long-short equity strategy, This applies generally to the equity market and involves the buying and selling of shares or the shorting of shares. And those strategies are typically broken down further into what we call a long-short aggressive, a long-short conservative, or a market neutral. Then you get your fixed income strategies. Now, these strategies, you can either gear on these strategies, and generally what they are looking to do is looking for mispriced assets in the market along the yield curve. So these strategies will predominantly either play the shorter end of the yield curve or the longer end of the yield curve, depending on the specialist who manages that strategy. Then you get commodity hedge funds, very bespoke, very niche area of the market, and they will look at things like commodities and agriculture and tend to have very, very low correlation to your traditional asset classes. And then lastly, you get multi-strategy. Now, multi-strategy is very similar to where you combine all these various strategies to make a very diversified portfolio. And you might hear of these sort of strategies in the market as being referred to a fund of hedge funds, or generally it could be the blend of the various strategies to provide you and your client more of a diverse exposure. So if you blended these strategies and you took a multi-strategy portfolio and you compared it to your traditional asset classes, be it your CISA general equity class, your multi-asset low equity, or your high equity or your income classes, you'll notice the very low correlation that hedge funds or these diverse strategy of hedge funds do have relative to your traditional asset classes. And just to highlight this even further, if you look at your normal equity fund or the CISA general equity category has a 97% correlation with the multi-asset high equity sector. In other words, a very high correlation. So therefore, should the SA market take a bit of a smack or a bit of a dip, your multi-asset high equity portfolio will do the same because of that high correlation. But you can see the low correlation that these individual CISA categories do have to hedge funds. So what does that mean practically? Well, if you look over the last 5 years, the risk return profile you would have got from the CISA multi-asset low equity funds, your high equity funds, and your general equity funds, if you just added a 10% exposure to a diverse hedge fund portfolio of diversified styles, you actually are reducing the risk of the portfolio, of the overall portfolio, and you're actually increasing the return profile due to that strong asymmetric return profile. So how can retail investors access hedge funds? Well, previously, you would only be able to access this alternative asset class through qualified investor hedge funds, commonly referred to as QIFs. These tend to have very, very high minimums. In other words, a minimum of R1 million investment. You used to have to be a qualified investor in order to access the hedge fund. These were only priced on a monthly basis, and the underlyings had to be able to repurchase within a 3-month calendar basis. When you compare on how the regulator has stepped in and made it more transparent, retail investor hedge funds are very much more similar to how we would do unit trusts. There is a much more stringent investment parameters that form part of these vehicles. They are aimed at knowledgeable investors and the general public. We will discuss the various licensing licenses need for financial advisors. The big thing here is that there is daily pricing on these portfolios. In other words, they can be loaded on list platforms that you can then consult and include in your wrap fund models or your fund models that you generally use for your clients, and that allows it to have greater access to the general public and domain. From a financial advisory perspective, the licenses required are, in terms of the FSP license, you need a 1.26 for a Cat 1 advisor and a 2.2 for a Cat 2. And that is the general level of advice that is needed. With regards to Regulation 28, you are only allowed a maximum of a 10% allocation to hedge funds under Regulation 28, which is 2.5% per fund maximum. Currently, Cisco doesn't allow one to for a CIS to invest in a hedge fund. In other words, fund of funds aren't available or aren't allowed to, as yet for now, invest in hedge funds. And then for post-retirement products, there is no limitation on or restriction to the amount of hedge funds that can be invested in. So it could be as high as 100% in that regard. Please bear in mind that all these licenses are applied on various list platforms according to their model set and the individual list platform rules and regulations. So in conclusion, a few points that bear repeating. Why should you consider hedge funds? It's the asymmetrical return profile, lower downside, and versus upside participation. Not all hedge funds are created equally, as I pointed out. You get various strategies which are very diverse within themselves, and all of them obviously have a very, very low correlation compared to your traditional asset classes that you would know, that you would be more comfortable and you would know. Availability, there's greater access provided to retail investors across the board from the product houses, the list platforms, and now the availability of the intermediary be able to get the right licensing to provide advice to the retail client.